Welcome to the world of retail stocks, a world of highs and lows, winners and losers. Today we'll be focusing on one of the giants of the industry, Macy's. As we delve into the bearish outlook for Macy's, it's essential to understand the contributing factors to its sales decline. One of the significant shifts we've witnessed in the retail landscape is the move towards e-commerce. Traditional brick-and-mortar stores are finding it increasingly difficult to compete with the convenience and variety that online shopping offers consumers. Macy's, long considered a titan in the department store sector, has also felt this seismic shift. Adding to Macy's woes are adverse macroeconomic headwinds. With inflation on the rise, consumers are grappling with increasing debt and declining discretionary spending. These factors have put extra pressure on Macy's, leading to a decline in its gross profits and a limited cash position. In an attempt to combat these challenges, Macy's has been making strategic moves. The company is trying to streamline its operations by focusing on smaller stores and expanding its online platform. However, these efforts have been met with skepticism by some industry watchers who view them as too little, too late. Macy's is currently in a precarious position. The company has a high short interest, indicating that some investors are betting on its stock price to fall. This, coupled with its declining stock value, paints a bleak picture of the company's financial health. Some even expect potential bankruptcy on the horizon. With a high short interest, expectations of potential bankruptcy, and a declining stock value, Macy's is at a critical point in its history. Can it recover, or is it too little too late? There are signs that the American consumer is reducing spending, signaling a potential economic downturn and recession, and this is impacting retailers like Macy's. Consider the case of Dollar General, a discount retailer. Their lower sales and profit forecasts suggest that their customers are feeling the pinch, and they're not alone. Macy's, a department store with a storied history, has also reported disappointing projections. The decline in demand indicates that consumers are shifting their spending habits, becoming more conservative in their purchases. Now let's think about the implications of this consumer slowdown. When consumers start to tighten their belts, it's not just the retailers who feel the impact. It reverberates through the whole economy. You see, consumer spending is a significant driver of economic growth. When people buy less, businesses make less money, which can lead to job cuts and a decrease in investment. All these factors combined can lead to a contraction in the economy. This contraction, or slowdown, is often a precursor to a recession, a period of economic decline spread across the economy that lasts more than a few months. And of course, this slowdown doesn't just stay within the borders of the United States, it has global implications as well. The US is a significant player in the global economy, and a slowdown here can impact economies around the world. But it's not just about the macroeconomic picture. Investors, take note. A consumer slowdown can pose a threat to stock market returns. When consumers spend less, company profits can take a hit, which can lead to a drop in stock prices. This can be particularly challenging for companies like Macy's, which are already grappling with a shift in consumer behavior from in-store shopping to online purchases. As a confident shopper base is crucial for a thriving economy, the current consumer slowdown could trigger a recession. How will this affect retailers like Macy's? The retail sector has been experiencing a sell-off, with the S&P 500 retailing index down 25% for the year. But there are some who believe this may be overdone. A peek into the options market reveals trades that indicate an optimistic belief. A striking example is a sale of July 145. Target puts worth $1.8 million, a clear bet on potential relief for retailers. Another hopeful sign is the purchase of 10,000 call options on Macy's, a wager on a 20% climb in the stock by mid-August. It seems that the declines in retail stocks have made them more attractive. The expectation is for issues like supply line pressures to ease and consumer spending habits to normalize within the next 6 months. With some believing the sell-off in retail stocks is overdone, there could be a potential relief for retailers. Could this be the light at the end of the tunnel Macy's needs? Let's summarize what we've learned today about Macy's and the retail industry. We started our journey with Macy's bleak outlook, witnessing its stumbling stock value and limited cash position. The company's struggle mirrors the overall weakness in the retail consumer market, further exacerbated by the shift towards e-commerce and adverse macroeconomic headwinds. Then we delved into the alarming signals indicating a potential economic slowdown. With American consumers tightening their purse strings, retailers like Macy's and Dollar General are feeling the pinch. This consumer slowdown could potentially trigger a recession, posing a threat to stock market returns. Lastly, we navigated the retail stock sell-off. While the S&P 500 retailing index has seen a significant dip, some believe this sell-off may be overdone. With expectations of easing supply line pressures and normalizing consumer spending habits, retail stocks may become more attractive in the coming months. Remember, the world of retail stocks is a roller coaster, full of ups and downs. So, stay informed, stay savvy, and don't forget to subscribe for more insights into the world of finance.